Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Zeta Global.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And we really do have a lot to cover today. This isn't just your standard, run-of-the-mill earnings review. We're looking at a company that honestly seems to be operating in a completely different reality compared to the rest of the software sector right now.
Yeah, I was looking at the wires yesterday morning. This is February 24th, 2026. And the buzz around Zeta Global is just palpable. They dropped their Q4 2025 earnings. And I mean, the reaction just feels different this time around.
Oh, absolutely.
But I do have to start with, a bit of skepticism here. Because I was reading the headlines, and everywhere I looked, I just kept seeing this exact phrase. 18th consecutive beat and raise.
It is a very catchy headline.
It is, but it makes me suspicious. I mean, when a company beats Wall Street, estimates 18 times in a row, that is 4.5 years straight, it usually means one of two things.
Right.
Either they are literally the greatest operators in the history of capitalism, or they are just master sandbaggers. Like, are they just setting the bar on the floor so they can step over it and look like heroes to you and me?
That is exactly the healthy skepticism every investor should have when they see a streak like that. And look, there is almost certainly some expectation management going on there.
Oh, for sure.
CFOs absolutely love to guide conservatively so they can pop the champagne later on the call. But here's the thing you have to keep in mind. You can game the expectations, sure, but you really cannot fake the absolute numbers on the scoreboard.
Okay, so let's look at the scoreboard then. Did they just inch over a lowered bar, or did they actually deliver the goods?
They didn't just inch over, they completely vaulted it. They achieved a record full year 2025 revenue of $1.3 billion.
Wow.
Yeah, that is a 30% year-over-year growth rate. And for the fourth quarter specifically, which was the one everyone was watching so closely, they hit $395 million in revenue. That beat their own guidance by $14 million.
$14 million is a significant beat on a single quarterly basis. It definitely suggests the business momentum is real.
Yeah.
But here's where I want to push back again just a little bit.
Go for it.
We just came out of 2025. That was obviously a massive election year with huge political spending across the board.
Right.
And Zeta is a data and marketing company. They do targeting.
Right.
So was this just a sugar rush from political ad spending? Because if it was, 2026 is going to be a pretty nasty hangover for anyone holding the stock.
That is the exact question the really smart institutional investors were asking on the earnings call. They wanted to know if this was just a one-hit wonder quarter fueled by campaign dollars.
Exactly.
But if you dig into the supplementary data they provided, the underlying story actually holds up perfectly. If you strip out the political candidate revenue entirely,
Okay.
and you even strip out their legacy Marigold enterprise business just to look at the core Zeta platform, their organic growth actually accelerated.
Wait, accelerated?
Yes, the core organic growth hit 28% in Q4.
So you're saying the engine that powers the main business like selling to insurance companies, retailers, auto manufacturers, that is actually speeding up, regardless of whether there is an election happening or not.
Exactly. The election money was nice, obviously, but it was really just the cherry on top. The cake itself is getting substantially bigger.
That's a great way to put it.
The core business is accelerating. It is not slowing down. And that perfectly brings us to the future because, as we always say, markets are forward-looking mechanisms.
Right. We can sit here and celebrate 2025 all we want, but the stock price today depends purely on 2026. And usually, when a company hits over $1 billion in revenue, the law of large numbers really starts to kick in.
It does.
It gets significantly harder to grow a massive number by a large percentage. You usually see that growth slow down to maybe 20% or even 15%.
And this is precisely why I'm calling this a major, significant inflection point for the stock. Management didn't just reaffirm their previous guidance, they actually raised it. For the full year of 2026, they raised revenue guidance to a midpoint of roughly $1.755 billion.
I mean, just do the math on that in my head. From $1.3 billion up to $1.755 billion. What kind of growth rate does that imply for the year?
That implies an acceleration to roughly 34 to 35% growth for 2026.
Wait, hold on a second. They grew 30% last year, and now that they are fundamentally a bigger company, they expect to grow 35% this year.
Yes.
That completely defies the usual physics of SaaS companies.
Yeah.
Usually, as you scale up, you slow down. Zeta is scaling up and speeding up at the exact same time.
It creates a very, very rare profile in the current market. But here is the absolute most important wealth building factor for you to consider. It is the thing that separates the speculative tech plays from the real long-term compounders.
What's that?
They're projecting this massive 35% acceleration while achieving JAP profitability.
Oh, let's pause right there and define gap for the listeners, because we see a whole lot of adjusted EBITDA thrown around in these tech earnings reports, which basically just means profit if we ignore all the really expensive stuff we have to pay for.
Exactly. Adjusted metrics are basically like stepping on a scale but subtracting the weight of your shoes, your heavy coat, and the big lunch you just ate.
Right.
GAAP, which stands for Generally Accepted Accounting Principles, is the real unadjusted scale. It accounts for stock-based compensation, interest, taxes, literally everything. And in Q4 2025, Zeta's GAAP net income turned positive at $6.5 million.
That is a massive psychological barrier for investors to cross. It proves business is actually self-sustaining. It's not just a cash incinerator.
Precisely. And if we look at the earnings per share, or EPS, they absolutely crushed the street's expectations. The consensus estimate was 23 cents. Zeta came in at 28 cents.
Wow.
That is a 23% surprise to the upside.
So often, we see these high-growth cloud stocks just losing money hand over fist, quarter after quarter, just to capture a sliver of market share. The whole argument for management is always growth at all costs.
Right, the old Silicon Valley playbook.
Exactly. But Zeta is basically saying we can grow faster than everyone else, and we can actually make real money doing it.
That's it, exactly. And that brings us straight to the engine room of the operation. How are they actually doing this? Because accounting profit is one thing, but cash flow is the true lifeblood of any company.
Right. Are they burning through cash reserves to fuel this 35% growth? Because typically to grow that fast, you have to spend an absolute fortune on sales and marketing teams.
They are not burning cash at all. They are practically printing it. Let's look at the financial health metrics. For the full year of 2025, their free cash flow was $165 million. That is up 78% year over year.
78% growth in free cash flow alone.
Yes. And for 2026, the new guidance projects free cash flow hitting approximately $231 million.
That is just a mountain of cash. And I really love cash flow stats because that is what gives a management team options.
Exactly.
When you have $230 million coming in the front door, you can buy smaller competitors, you can aggressively buy back your own stock to reward shareholders, or you could just safely weather a severe recession if one hits. But I really want to dig into why this is happening. How efficient are they really at acquiring these customers?
This is hands down one of my favorite metrics to look at for software companies, and it completely explains everything we just discussed. It is their CAC payback period.
Okay, so CAC stands for Customer Acquisition Cost. For those who might not track SaaS metrics daily, that is basically how long it takes for the company to earn back the sales commissions and marketing dollars they spent just to land a new client.
Correct. And in the software world, anything under 12 months is considered really great. If you spend $1 to acquire a customer and you get that dollar back in profit within a year, you are doing incredibly well.
Right.
Zeta's CAC payback period is currently 5.6 months.
5.6 months. That is incredibly fast. That is less than 2 full business quarters.
It is entirely best in class.
Mm-hmm.
Think of it kind of like a vending machine.
Okay.
You put $1 in, most good tech companies have to wait a whole year for the machine to give their dollar back. Zeta puts $1 in and gets it back in less than 6 months. Every single month after that is pure profit contribution to the bottom line.
It honestly sounds like a money printing machine. But if the payback is that short, why wouldn't they just take that $230 million and spend every single dime of it on marketing to grow even faster?
That is exactly the dynamic that gives them so much operational flexibility. They can aggressively reinvest in their sales teams because they know the money returns almost immediately. It creates this massive flywheel effect.
Okay, I see.
But the real reason they can pull this off pivots us directly to the business model itself. Why is Zeta winning these deals? What is their actual moat?
Right, because they are not operating in a vacuum.
Hmm.
We have massive giants in this space like Salesforce, Adobe, Oracle. These aren't small, scrappy startups. They're behemoths. Why is Zeta able to acquire customers so efficiently against that kind of entrenched competition?
Because Zeta isn't just another Me Too software company trying to copy the giants. They have a very distinct competitive moat built on 2 main pillars. First, a proprietary AI-powered marketing cloud. And second, and this is the real key, a hybrid, usage-based monetization model.
Let's unpack that usage-based concept versus the traditional model, because I think most of us are very used to the standard Salesforce model where you pay for a seat. You pay a monthly fee per employee who has a login, regardless of whether that employee actually logs in and uses the software or not.
Right. That is the classic subscription seat model. It is fantastic for the software vendor because the revenue is highly predictable. But it can be incredibly annoying for the client if they aren't getting actual value. We call that shelfware in the industry. You buy it, sits on the digital shelf, and you resent paying for it. Zeta operates entirely differently. Their model completely aligns their revenue with customer success and usage intensity. It is consumption-based.
So the more the customer actively uses the platform, and theoretically the more value and sales they're getting out of it, the more Zeta gets paid.
Exactly. And this creates a fundamentally different dynamic for the business. In an economic recession, seat-based models can be somewhat sticky, but eventually companies just fire employees and cut those software seats to save money.
Right, we've seen a lot of that recently.
But with a usage-based model, if the product is actually working, if it is actively driving new sales leads for the client will actually use it more even in a downturn. Because in a downturn, they are desperate for revenue.
It completely aligns their incentives. If Zeta's AI is directly making my company money, I'm going to happily spend more money with Zeta.
And that dynamic leads directly to their super-scaled customer metric.
What's that?
These are their truly high-value accounts, the ones bringing in more than $1 million in revenue each. They now have 184 of these super-scaled customers, which is up 24% year over year.
That naturally brings up the AI aspect of all this, because let's be honest, everyone claims to have AI right now. If I had a nickel for every earnings call this quarter that mentioned AI, I would be retired on a beach.
We all would be.
What actually makes Zeta's AI different from, say, Adobe's Firefly or Salesforce's Einstein?
It is all about the fuel. AI itself is just an engine, but data is the fuel that makes it run.
Okay.
Many competitors have really great AI engines, but they rely on the client to bring their own data to the platform. Zeta has spent years building a proprietary data cloud. They have aggregated data across billions of consumer profiles. We're talking identities, purchasing behaviors, intent signals.
So they aren't just selling you the targeting tool. They are handing you the map and the specific list of targets to go after.
Exactly. The AI uses this vast proprietary data lake to dramatically improve ad targeting. Better targeting directly means a better return on investment for the client. Better ROI means the client spends more money on the platform.
That makes perfect sense.
And here is the real network effect. As the client spends more and runs more campaigns, the Zeta system gathers even more performance data, which in turn makes the AI even smarter for the next campaign.
It is a complete self-reinforcing loop.
And it creates massive lock-in. Think about it. If you are a marketing director at a huge brand, and Zeta's AI is consistently giving you a 20% better return on your ad spend than Adobe solely because of Zeta's unique data, are you really going to switch vendors?
No way. The switching costs are way too high. You would immediately lose that performance edge and probably your job.
Exactly. That data is their impenetrable moat, and it certainly seems like the smart money in the market has already figured this out.
I really want to shift gears to what the market is actually doing with the stock, because we can sit here and love the fundamental story all day, but if the stock chart is broken, it doesn't really matter for wealth building. You mentioned some really interesting activity leading up to this earnings report.
I did. This is where we get to put our detective hats on.
Yeah.
On February 20th, 2026, so this was just 4 days before the earnings dropped, Zeta was flagged in a major market report highlighting 10 information technology stocks with unusual whale activity.
Whale activity. So we're talking about massive institutional orders, block trades, the big boys on Wall Street moving their chips around.
Exactly. When you see significant whale activity right before an earnings print, it usually strongly suggests that massive institutional investors are quietly positioning themselves for a beat. They are accumulating shares before the retail crowd catches on. It is a very bullish technical signal.
It is basically like seeing the sharks circling the water. You know something big is about to happen. And obviously those institutions were dead right. The stock traded up 1.5% immediately after that report broke, and then it really popped after the actual earnings release.
And it wasn't just the earnings report driving that momentum. There was other significant news hitting the wire, too. On February 18th, they formally announced a strategic partnership with NextActive.
NextActive. I'm not super familiar with them. Why does that specific partnership matter for Zeta's valuation?
This partnership specifically expands their AI capabilities deep into omnichannel campaigns. Omnichannel is really just a fancy marketing word for following the consumer absolutely everywhere they go. Email, social media, connected TV, mobile apps.
Oh, I see.
It strengthens that data moat we just talked about by making Zeta the ultimate one-stop shop for a chief marketing officer. They don't need 5 different vendors anymore.
It really seems like the overarching narrative on Wall Street is shifting in their favor. I actually saw an article on February 17th with a headline that made me laugh out loud called Zeta, the Wrong Suspocalypse Victim.
Oh, that was a fantastic piece of analysis. The core argument there was essentially that the broader market had blindly punished Zeta, along with all the other bloated software stocks during the recent tech downturns. They were treating them all exactly the same.
Right.
The market just said, software is dead, sell everything with a cloud logo. But the author argued that Zeta is highly resilient specifically because of that unique usage-based business model and their massive free cash flow generation.
They aren't just another unprofitable SaaS company burning venture capital.
Exactly. So they shouldn't be priced or punished like one.
And now, with these blowout earnings, it really feels like the market is finally waking up to that crucial distinction. Analysts are scrambling to revise their estimates upward. The overall sentiment score from what I'm seeing seems overwhelmingly bullish.
It really is. The combination of the massive earnings beat, the raised 2026 guidance, crossing into GAAP profitability, and the institutional whale accumulation. It all creates a very, very strong technical and fundamental setup for the stock.
However,
Yeah,
and you know there's always a however on this show, we have to remain entirely objective for you, the listener.
always.
Right now, everything sounds way too good. It sounds absolutely perfect. So I want you to put on your bear hat and play the role of the ultimate pessimist. What could actually go wrong here? What creates the bear case for Zeta?
It is incredibly important to stay grounded when a stock is running hot. There are 2 primary risks here that could derail the thesis. Risk number 1 is actually the double-edged sword of that exact business model we were just praising, macro volatility.
Explain that for me. Because you just said the usage model was a huge benefit because clients will spend more if the tool works.
It is a massive benefit when the overall economy is expanding or even just staying flat. But think about the harsh reality of corporate finance. If the global economy hits a severe, hard recession tomorrow, corporate marketing budgets are always the very first thing to get cut.
Right?
It is the easiest, quickest line item for a panicked CFO to slash. Now, because Zeta is completely usage-based, a sudden drop in client usage hits their top-line revenue much faster than a standard subscription model.
I see the trap there. In a subscription model, the client is locked into a rigid 1-year or 3-year contract. The vendor gets paid their monthly fee even if the client completely hates the software or stops using it entirely. But in a usage model, they can just turn off the spigot tomorrow to save cash.
Exactly. So the downside volatility is mathematically much higher in a sudden recession. Their revenue could evaporate much quicker than a company like Salesforce.
That's a very real risk.
However, the fair counterpoint to that bear argument is their current 18-quarter streak. They have successfully navigated plenty of economic choppiness over the last 4 years, and they have just kept right on growing. But it absolutely remains a structural risk that investors need to accept.
Fair enough. What is risk number 2?
Competition, plain and simple. We mentioned Salesforce and Adobe earlier. These are not small, struggling companies. They have tens of billions of dollars in R&D budgets. And they certainly aren't just sleeping at the wheel.
True.
The major risk is that these giants begin to aggressively bundle new AI features into their existing platforms for free just to try to commoditize what Zeta does.
Basically, Adobe walks into a client's office and says, hey, we will give you all this advanced AI targeting stuff for absolutely free if you just sign a new 3-year enterprise contract for our creative design suite.
Exactly. It's intense pricing pressure. It creates the good enough problem. If the free AI tool bundled from Adobe is deemed good enough by the finance department, does the marketing team really need to pay a premium for Zeta? Zeta completely relies on their performance being so vastly superior that it easily justifies the added cost. If that performance gap ever narrows, they are in serious trouble.
So the entire bullish thesis completely depends on them flawlessly maintaining that proprietary data advantage.
It does.
Okay, we have thoroughly looked at the past performance, the future guidance, the incredibly good metrics, and the very real bad scenarios. It is time for the final verdict. Based on absolutely everything we've unpacked today, I am looking for a final score in your core investment thesis. How do you rate Zeta Global right now?
Taking everything into account, I am giving Zeta Global a very strong bullish score of 8.5 out of 10.
8.5 is a very high score for this market. Walk me through the exact rationale for that number.
It really comes down to three unshakable pillars: execution, inflection, and acceleration. First, execution. Delivering 18 consecutive beat and raises clearly shows this management team knows exactly what they are doing and how to operate their business. Second, inflection. They have successfully crossed the dangerous bridge from burning cash into true, sustainable GAAP profitability.
And the third.
Acceleration. Their top-line revenue growth is literally going from 30% up to 35% while operating at a massive scale. You very rarely find that magical combination of accelerating hypergrowth and real accounting profit. Usually, Wall Street forces you to pick just one.
So for the listeners who are looking at their brokerage accounts right now, what are the actionable price targets? How should they be thinking about structuring this trade?
I like to break this down into two distinct timelines depending on your strategy. First, you have the swing trade. This is purely for the shorter-term trader who is looking at the next 3 to 4 months, specifically leading into the Q1 2026 earnings report in April.
Okay, so that is a short-term momentum play.
Exactly. For that swing trade, my price target is $19 to $21. This is entirely driven by the current market momentum, the psychological tailwind of the beat and raise narrative, and that institutional whale activity we saw. The stock is currently sitting around $17.20, so that represents a really nice 10 to 20% pop in the short term.
And what about for the long-term investor? Someone who wants to buy this, put it away in their portfolio, and hold it for a few years.
For the multi-year hold, looking out to the 2026 through 2028 timeframe, my target is $28 to $35.
Wow, that is a potential double from the current price.
It is. And that isn't just a random moonshot number I pulled out of thin air. It is mathematically driven by their stated long-term financial goals. Management has publicly targeted hitting $573 million in EBITDA by the year 2028.
Okay.
If they actually hit that profitability number, a $30 plus stock price is very reasonable based on standard historical software valuation multiples.
I have to ask, is there any wild card in play here? A joker card in the deck that could completely change the math overnight?
There is one highly speculative catalyst that we really haven't touched on much yet: mergers and acquisitions.
Interesting.
With this massive amount of cash flow, again, $231 million projected just for this year, and that completely unique proprietary data asset, Zeta becomes a very, very attractive acquisition target for a larger player.
Who realistically buys them at this valuation?
It could be a legacy advertising holding company, someone like a Publicis or an Omnicom that desperately needs to get smarter on AI technology to survive. Or it could even be a massive big tech player who simply missed the boat on ad tech AI entirely. They could look at Zeta's platform and say, we have the cash, we just need to buy that engine right now.
So as an investor, you get the hypergrowth, you get the fundamental GAAP profit, and you effectively get a free lottery ticket on a massive potential buyout premium.
Exactly. It is a highly compelling setup across the board.
Well, there you have it. You've got accelerating top-line growth, true profitability, and the institutional whales are clearly swimming in the water. It is a truly fascinating wealth-building story. But as we said earlier, you must keep a close eye on the broader macroeconomy, because that usage-based model can absolutely cut both ways if a recession hits.
It really is one of the most interesting and unique setups in the entire software space right now.
As always, we have to remind you, we are deeply analyzing the data and bringing you the catalyst breakdowns, but you need to do your own research. Check the technical charts, read the fundamental reports, and make the investment decision that best fits your specific portfolio goals.
Knowledge is power, but execution is everything.
Thanks for joining us on Smart Wealth with Joshua. We'll see you tomorrow.